One of the very first questions I get asked when someone inquires about a reverse mortgage for the first time is, how much do I qualify for? And unfortunately, the answer isn't as simple as you would think. If you've done any reverse mortgage research prior to landing on this video, you may have found that the amount that you qualify for is based on three pieces of criteria: your age, or if you're married, the youngest spouse's age, your home's appraised value, and long-term interest rates. But what the heck does that even mean? Long-term interest rates. The information online about how your loan amount is actually calculated is pretty vague. And the reason for that is it's really confusing and complicated how it all works. And unfortunately, because of the confusing and complex nature of how this works, many times folks looking into a reverse mortgage aren't being educated on this at all. I have folks calling in left and right who have spoken with other companies and have no clue about how this works. And the major problem that this poses is that folks are getting reverse mortgage proposals from these companies and they're not aware of how their loan amount is being calculated, and that those numbers or the amount that they qualify for can actually change on a weekly basis. So they're getting these numbers proposed to them and then understandably taking a few weeks, maybe even longer, to review and consider those numbers with an understanding of how much they qualify for, only to finally call that loan officer back to find out that now, a month and a half later, they qualify for a lot less. So this video is vital in helping you understand exactly how loan amounts are calculated with reverse mortgages. And more importantly, we'll also be discussing why and how your loan amount can change on a weekly basis and how you can stop it from changing to prevent possible reduction in how much you qualify for. Hey everyone, for those that may not know me already, my name is Taryn Proctor. I am the president of Retirement Home Equity Advisors. We are a mortgage brokerage that only specializes in reverse mortgage financing. I create videos like this just about every week to educate folks like yourself about this pretty complex financial tool. And because of the complex nature of this loan, it's so important that people educate themselves as much as possible so that at the end of the day, you are able to make the most well-informed decisions regarding this product. So if you enjoyed today's video, then do me a favor and like the video and then head on over to our channel to subscribe. Go ahead and also hit that notification bell as well if you'd like to be notified when I post new videos. All right, so how are reverse mortgage loan amounts calculated? When you get a reverse mortgage, you are not required to make monthly principal and interest payments. And although you can make payments if you'd like, most people choose not to. That's kind of the whole point for them, is eliminating their monthly mortgage payment or cashing out money out of their home and not being required to make payments on the amount borrowed. But if you are not making payments towards the mortgage, that means the interest that the loan is incurring is now being added to your loan balance on a monthly basis. Therefore, most folks who have a reverse mortgage have an increasing loan balance over time. So the federal government had to come up with a way to reduce the risk that your loan balance would ever exceed the home's value. Because if you have a loan where the loan balance is increasing over time, you are at a much greater risk of becoming upside down on the loan. And although the federal insurance for this loan protects you in that event, the federal government still wants to try to prevent this from happening in the first place. They still want there to be equity left for you or your heirs at the end of the day. And if you aren't familiar with how reverse mortgage insurance works, I'll put a link to a video I did on this topic down below in the description of this video. So you'll want to check that out. But the solution for them was to tie long-term interest rates to the qualification factors of reverse mortgage borrowers. This means that if your loan interest rate is estimated to be higher over the course of the loan, the amount you qualify for is not going to be as much. And vice versa as well. If your loan interest rate is estimated to be lower, then you will qualify for more. And the phrase long-term interest rates simply refers to what it's estimated your interest rate will average over a period of time, not just in the present. And the federal government did it this way because if your interest rate is assumed to be higher over time, they want to leave more equity in the home to allow room for the loan balance to grow a bit quicker throughout the life of the loan. And when the long term rates are lower, they're okay with you having more of the home's equity because the loan balance will be growing slower and the risk for you becoming upside down on the loan doesn't increase. Now, anyone considering a reverse mortgage will have the option of a fixed interest rate or an adjustable interest rate loan. Both of these options work a bit differently, so let's go over both. With a fixed interest rate reverse mortgage, this topic is much easier to explain because the interest rate is fixed for the life of the loan. It never adjusts. So with a fixed rate reverse mortgage, it's easy to determine what the long-term interest rate will be because that will be whatever the interest rate starts out at. So pretty simple. With the fixed rate option, if your loan interest rate is higher, the amount you qualify for will be lower. And when the fixed interest rate is lower, the amount you qualify for will increase. Also important to note here, there is a floor rate that the federal government has set. That says at this particular lowest interest rate, which is 3%, everyone qualifies for the absolute maximum amount that they can qualify for at whatever age they are. But then with every 1/8% that long-term rates rise, it decreases how much any one person qualifies for little by little. So in times of rising rates or high long-term interest rate environments, such as the one we're in right now, this becomes even more important to know and understand. Of course, as I mentioned before, you also will have the option of an adjustable interest rate reverse mortgage, which a good majority of reverse mortgages wind up being adjustable rate. And if you haven't watched my video on this topic, I'll also put a link to that video down below in the description of this one. So I would highly recommend watching that as well. Now, for the adjustable interest rate option, this becomes a bit more tricky because how are you supposed to estimate what an interest rate will average over the course of a loan if it's adjusting? Well, to be honest, you really can't. But the federal government did its best to try and come up with a fair way to determine this. So, what they came up with is this. Now, keep in mind, before we get into this part, that the rates we are talking about for the adjustable are not your actual loan interest rates. The long-term rates we are talking about are solely used for the purpose of determining your loan amount. So what we are required to do here, and when I say we, I mean all reverse mortgage professionals, we must look at an index called the 10-year constant maturity treasury rate. This particular index has a closing rate Monday through Friday, similar to the stock market. And federal regulations require that we take that closing rate Monday through Friday and we average that out for the week. Whatever that averages out to then goes to help determine reverse mortgage loan amounts the next week, beginning every Tuesday in most cases, unless there is a federal holiday. And when this average goes up, this is what reduces how much folks qualify for in the adjustable rate option. And when that average goes down, yes, you guessed it, everyone qualifies for more. Now, in all fairness, you can probably see why many people are not being educated on this topic when they call some companies. And I'm sure many of you that just watched this whole thing may still be confused. And that's okay because it is very confusing. Luckily, you can rewind and rewatch these videos. So I would certainly recommend doing that if things are still a bit sticky. As well as you learn more about how reverse mortgages work, this topic will probably begin to make more and more sense to you. So if you land in that category, definitely go check out my channel and watch some of the other educational videos there. There is a lot for you to learn, and you can take your time going through the many videos I've done in the past. But if you take anything from this video, I hope it's this next piece because it's more important than the complex way your loan amount is calculated. First, let me take a step back for a moment to discuss what it actually means when we say how much you qualify for. Because when you are looking into a reverse mortgage, there is no set dollar amount that you will qualify for. The amount that you qualify for is actually based on a percent of your home's appraised value. So your age and those long-term interest rate averages determine what percent of your home's appraised value you qualify for. And it is this percent that increases or decreases when that long-term rate average increases or decreases. This is important because at the beginning of the process, one major thing no reverse mortgage professional will be able to 100% determine is what your home will appraise for. That is why your reverse mortgage loan amount is based on a percent of the home's appraised value. So 1 week, you may qualify for 40% of the appraised value. And the next week, if those long-term interest rates rise, you may now only qualify for 38% of the appraised value. Now, like I said before, those long-term rate averages get updated every Tuesday. That means if you call up a loan officer on a Thursday and they quote you or discuss with you the specifics of how much you may qualify for, those numbers may change 5 days later when the next Tuesday rolls around, and every Tuesday after that. I say may because it isn't always that the long-term rate average increases or decreases enough to alter your loan amount. As well, this can, of course, wind up working out in your favor when rates begin to come back down. But as for the time of this video, we're still in a rising rate environment. And why this is so important for you to be aware of is because if you're seriously considering a reverse mortgage, of course, you want to know those initial numbers can change. But more importantly, you need to know how you can stop them from changing further, especially if you are at risk of qualifying for less. And how you're able to do this is when you complete an application with a lender or broker. When that application is completed, you get locked into whatever those long-term rate averages were during that particular week. This protects you throughout the rest of the loan transaction from your loan amount or the percent that you qualify for from decreasing if those long-term rates increase during that time. Then at the time of your loan closing, if those long-term rate averages are better, which allows you to qualify for more, you do get to take advantage of the higher qualification amount at closing. And let me reiterate one more time here that we are not talking about locking you into your actual loan interest rate. We are talking about locking you into the long-term rate average that determines the amount you qualify for. So that lock-in period only has to do with protecting how much you qualify for. This may not seem like that big of a deal, but as a reverse mortgage professional, it's very important that we keep an eye on these things for our clients and for you to be aware of, because this can wind up being the difference between a reverse mortgage being feasible for you or not, or a difference of tens of thousands of dollars in your loan amount. And it can happen very quickly. And unfortunately, many of you watching are not located in states that we are licensed in currently, which is Arizona, California, and Colorado, and actually soon to be Florida and Texas. Not quite there yet with Florida and Texas, but it is coming soon. So, especially for those that we cannot actually help through the transaction, it makes it that much more important for you to be aware of these things if the loan officer that you wind up working with doesn't get very deep into the intricacies of these regulations with you. But certainly, even if you're not from a state we currently service, you can always feel free to reach out with any questions. And that's it for today, folks. I hope that you learned something valuable today. And again, if you feel you did, give the video a like and subscribe to our channel so that you have access to my videos as they come out. And if you or someone you know has any questions about today's topic or about reverse mortgages in general, please feel free to give me a call anytime. You can reach me at 888-982-0475. Thanks for watching, and I hope you have a fantastic rest of the week.